Hello, this is Mike Smith, and welcome to this week's edition of the Lowdown. So this week you've submitted a lot of great questions. One of the questions, could we potentially be heading for a recession? How long and severe will inflation persist? And then also questions about Fed policy and response. Let's dive right in. According to the National Bureau of Economic Research, this is the organization that officially announces if we're in a recession. Think of it about it like a referee. They define a recession as a significant decline in economic activity spread across the economy lasting more than a few months. However, by the time the NBER announces that we're in a recession, the stock market has already reacted. So as investors, we need to look at the signs for what could cause a recession if we're going to be prepared. This chart is showing the maximum drawdowns during major recessions since World War II. You can see here in the 2001 and 2007, bear markets were particularly ugly. This is why in our financial plans for our clients, we do what's called a stress test. Our clients know what their portfolio's downside risk is for each 10% decline in the market. When we apply the stress test scenario to the portfolio, knowing how your portfolio will respond to market volatility will allow you to remain in the mindset needed to ride out the storm. Doing the stress test prior to periods of market volatility will help you make good decisions about excessive risk in your portfolio so you can take action before, not during or not after, which by the way, which is typically what happens. People make decisions when it's too late. Let's talk about the 4 specific markers of a recession: loss of jobs, declining real income, production and manufacturing slowdown, and lower consumer spending. All of those are bad individually and worse together. If they persist for months, only then would I call it a recession. Remember, this will be a strange recession and unlike any recession we've seen in the past. A mistake I see over and over again is investors think the next recession will look like the previous one. However, most are very different from the initial catalyst to the market reaction. Also remember, the stock market will react prior to any official recession announcement. It doesn't have to have the normal causes and may not have the normal effects. Loss of jobs is the first marker of recession I listed. Take a look at this chart. Of all the employees, this is total non-farm. As you can see here, jobs are growing steadily until the COVID recession. They fell hard and it has not fully recovered. We have been making good progress though. The Fed beginning to tighten, higher energy prices, war-related disruptions will start to affect us soon. One of the concerns, businesses who are looking to hire right now could see slower growth and sales and stop hiring. Now let's take a look at the second marker, declining incomes. As you can see from this chart of real disposable personal income, income is popping sharply higher in the 3 peaks, which correspond to the 3 COVID stimulus bills. If you extrapolate the pre-COVID trend forward, today's level is about where it should be. We've all heard stories by now of waiters walking into restaurants. They're demanding higher pay, from $16 an hour to $20 an hour. That may actually be behind us, and wages could stagnate and not keep up with the cost of living going forward. The third marker is manufacturing slowdown. It does not take much to disrupt production post-COVID. This is almost certain to decline as the war makes components and materials even harder to obtain than they are now. More interruptions as the war's direct impact as well as the sanctions work their way through the economy. For example, the microchip shortage was on the mend but may now even get worse. All of this has a snowball effect of one which will be lower output. The last marker of a recession is inflation. Inflation and how it could lower consumer spending, to be exact. We're already seeing signs of this. A few examples, people are talking about sharing rides, eating out less. We're hearing domestic travel versus international. I would encourage you, if you've not seen the podcast we did with Burl East, we go into inflation in great detail. As a matter of fact, we talk about this into 3 different segments: logistics and supply chain disruptions, labor shortages and wage increases, asset bubbles created by monetary and fiscal policy. So the first, supply chain disruptions. Currently, you've heard China's growing COVID outbreak, which is now closing factories again and may lead to more supply chain issues. Some have interpreted this to be bullish, thinking that China's slowdown will reduce energy and commodity prices. That may be correct, but not for more than a few weeks. However, some of the areas have already recovered from spikes in prices. Do you remember lumber prices? They're down 22% from the early peak in March. Many of the closed mills are back online. Prior to the war with Russia and Ukraine, I would have thought lots of the supply chain issues would be resolved within this year. However, the uncertainty to the outcome and length of the war is going to push this recovery out further, and leave some uncertainty in regard to how long. We talked about labor shortages and wage increases. I believe that this has ran its course in regards to what I mentioned earlier about disposable income. And finally, asset bubbles created by monetary and fiscal policy. $6 trillion were printed during COVID, and today some of that remains unspent. The Federal Reserve's in a trap with their focus to combat inflation, or what they call demand destruction. So the question is, will the slow growth push us into a recession and hurt the other part of the dual mandate, which is price stability and employment? In the recent speech by the Federal Reserve Chairman Jerome Powell, he pointed out that the Fed has orchestrated soft landings before. As a matter of fact, he pointed to 3 of them. What he neglected to tell you is those soft landings were followed by rapid rate cuts. Demand destruction is the way forward for the Fed. It is all simple to say. It is not positive for employment or growth either. And this is where we are now. Is the Fed in a trap and at risk of destroying one of their dual mandates by trying to solve the other? Recall, the Fed's dual mandate is price stability, which is inflation, the one they're choosing to fight. The second mandate is full employment, which is the one they could destroy. That's a difficult choice facing Jerome Powell and the Federal Reserve. The current go slow, which is basically 25 basis points per meeting, that is the plan. That could have a desired effect on not spooking the financial markets, but it will also let inflation expectations increase and lead to more wage and price spirals. I can't emphasize enough how dangerous this particular environment is. Numerous economists and analysts believe Powell's got everything under control, and he'll taper the balance sheet more than expected. I hope they're right, and one of the things I'll tell you is know your downside. Make decisions about risk now. Look, it's been a crazy week. Thanks for watching The Lowdown. If you need anything, make sure you send me an email, and we'll see you next week.